The S&P 500 has pulled back from record highs despite US inflation falling more than expected. It's great to have your company. Today's the 14th day of January. My name is Jessica Amir, market strategist here with Moomoo. So what on earth is going on? Well, traders and investors are assessing Trump's latest barrage of demands ahead of this year's US midterm elections. And basically, investors and traders are trying to really understand what this could mean for companies that they're invested in. And obviously, that's a reflection of the stock market. So as a result, what we saw overnight is investors are basically taking profits until we wait and see if Trump's demands stick. And at the same time, we want to see clear evidence from upcoming earnings reports that companies' profits are large enough to withstand whatever on earth Trump's policy pressures put on companies. That's basically the bottom line. That's all you need to know. So markets right now are assessing the latest barrage of headlines from Trump saying he wants there to be a credit card cap. Trump wants a 1-year cap at 10%, and that's why we saw bank and payment stocks fall. Visa was one of those hit the hardest, down 4.5%. Block also copping it on the chin, down 4.3%. And you'd expect the Aussie listed Block to follow suit. In the tech and AI space, we also saw cost pressures, really because Trump is basically calling on all AI and tech companies to not pass on higher energy costs because of higher data centers as well. So he basically wants these businesses to pay their own way. He literally said that. So instead of companies passing on rising electricity bills to Americans or consumers, he wants businesses to cop that. Now, this is why we saw Salesforce shares down 7%, and that also followed Adobe, SMCI. They were three of some of the worst performers overnight. Microsoft also down in the large end of town. That fell the most after the company said that they are going to pledge to make changes to their own businesses so that they do not impact consumers. What you need to know and take away from all this before we get to the focus of the day and the stocks to watch is that volatility is very low for now, but you would be remiss or pretty silly if you didn't expect volatility to pick up. And remember, this is exactly what we saw 6 to 7 years ago in Trump's first term. History never repeats itself, as Mark Twain said, but it does rhyme. So that means it could take days or weeks for markets to digest the headlines and then stabilize. So you might be looking for a pullback here before markets return to modus operandi and rise on the back of expectations that we're going to have a good year ahead. But let's just focus on why US banks could face a bumpy but ultimately a positive ride this year. So let's just pull that apart. So far this month, financials are the only major sector in the US in the red. That's right, the only major sector in the red. Can you believe it? They're down 1%. Whereas last month in December, banks were the best performer in the US. So what's going on? Well, institutions are bracing for a bumpy quarter. And this is really notable based on the headlines that we saw overnight. JP Chase as well, one of those CEOs to basically come out and saying what Trump has said is not going to be good, not just for the bank themselves, but also the consumers. We'll get to that. But what you need to know as an investor right now, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, all these stocks, these big four heavyweights, have been trading near record all-time highs or 52-week highs. And why is that? Well, the market was getting ready for deregulation, tax cuts, stronger trading activity because of the US midterm election. But now these expectations are being tested. And so here are the 4 reasons that you need to watch banks, but expect a bumpy but positive run. So the first thing to consider is just reiterating the point, why are banks' valuations being tested right now? Please remember, banks are like markets. They don't go up in a straight line. As we just said, banks were the best performers last month, and now they're the worst performers. So they're basically seeing profit taking. Their valuations are being questioned because if Trump's proposed 1-year cap on credit cards stick. That will come into place on January 20. JP Morgan Chase said it will radically change the company's business model, and this basically reflects what you will probably see in banks as well. JP Morgan said it's not only going to be bad for consumers, would you believe, but also bad for the economy. So for consumers, when we hear that we're going to hear a cap on credit card interest to 10%, it might sound great. It might sound like a consumer-friendly win. I think it is. But JP Morgan Chase said it would actually restrict credit availability, it would reduce banks' profitability, and ultimately it will hurt consumers. And this is exactly why investors are reassessing banks right here, right now. That said, the outlook for banks in 2026 remains pretty positive. Why is that, Jess? Well, US banks are expected to deliver strong earnings growth. So 6.4% profit earnings growth this year, 8% the year after. Whereas Aussie banks, they're kind of not really near that. Aussie banks are expected to see 6% profit growth this year, or earnings growth rather, and 4% the year after. Basically, what you need to know is banks right now are resetting expectations for a bumpy adjustment. The second thing to consider is the medium-term tailwinds for banks remains intact. Capital markets, they're expected to benefit strongly from the 3 interest rate cuts that we've seen in the US. Plus, we're getting a potential tax relief, deregulation, and we're expecting mergers and acquisitions and IPOs in 2026. And this basically means banks should do well this year. The third thing to consider is banks' trading activity and the wealth effect do support banks. So we typically do see strong trading conditions ahead of and after a midterm election. And going back to the trading wealth effect phenomenon, what we need to consider with this, if you don't know what the wealth effect is, just as a reminder, when we see rising asset prices, that's rising property prices or rising stock market, trading at record all-time highs. This basically encourages investing and consumer sentiment. And this is the thinking that this rise in trading and the wealth effect is going to underpin earnings for this year. The fourth consideration with banks is that going back to the midterm election dynamic. So why is this favourable? Well, before, during, and after the midterm elections throughout history, we've seen strong trading activity, strong trading volumes, and this tends to benefit those large, diversified US banks that are actually making money from people trading. So we've gone through a lot today, but just before we go on to the stocks to watch, the takeaway is if you are looking to add banks to your investment portfolios, you just might want to be wary that institutions right now, they're taking profits. So you may want to wait a couple of days or maybe a week or so before you buy in if you are a long-term investor, or if you're a swing trader, that's for you to consider. We're probably going to see a pullback here or consolidation for the coming days or week, is basically what I'm trying to say. And of course, we know history never repeats itself, but it does rhyme. US banks, the ones that I've covered today, have always recovered from market crashes in the past. And history, if it's in its favour and we see a repeat of that, the banks that we've covered, indeed the big four, are probably going to see a bounce back once uncertainty clears. So that's something for you to consider. But do also remember, if you are thinking about Aussie banks down under in Australia, remember that Aussie banks do deliver far superior dividends than US banks. So you could have buying opportunities ahead. Now, the other thing to consider is we're going to get a slew of banks' earnings ahead. Obviously, we just heard JP Morgan Chase overnight. The next banks to report tonight in the US are Bank of America, Citigroup, and Wells Fargo. Then, of course, we hear from the big investment banks, those that are making lots of money from trading, Goldman Sachs and Morgan Stanley. They report US Thursday. Now let's dive deeper into the investments to watch. Let's kick off with Wells Fargo. They report before the US market opens tonight alongside Citi and Bank of America. So what are we expecting? Well, The market is a little bit skeptical. I think we're seeing that exercised across banks overall, but Wells Fargo shares are down about 1.5% overnight, again, on the back of that credit card deregulation concern. But the stock has done really well of late. As we said, it has been trading around record all time highs. The stock rose 33% last year, and it's already up almost 10% this year. Let's call it 9.5% for those who like to be specific. Now, what is the bank expected to report tonight? Well, 1.67 earnings per share. That's $1.67 earnings per share based on roughly $21.7 billion of revenue. If that number is seen in their earnings, that'll be a 17% rise year on year in their earnings. So really strong numbers. Again, this is nothing like what we see in Australia as well. Far cry from what we see in Australia, maybe even a fraction of that. But analysts have been lifting earnings for Wells Fargo. This earnings upgrade cycle, you could argue, started in October last year. Barclays recently reiterated the stock as a buy. Now, price targets are putting the stock on a 12-month price target ranging between $100.68 to $103. But it basically is suggesting moderate upside from the current close of $93.56. Let's change pace to a big tech stock that is making waves, and that's Intel. Well, some tech stocks were on the nose last night. Intel surged 7.3%, taking this year's gains to almost 30%. Can you believe it? And last year it rose 100%. Now, the rally since August has pushed the stock closer to highs that we saw earlier this decade in the year 2000. And so what happened? Why this massive rush of momentum or exuberance into the stock overnight? Well, we saw an investment house bank called KeyBank upgrading Intel to a buy. They basically took Intel's price target from $47 to $60. So this reflects the fact that Intel is selling out of their GPUs. They basically came out saying this earlier. They've sold out all of their GPUs for this year, right? And that's very similar to what AMD previously announced. What is also expected to take place is Intel is expected to overtake Samsung in advanced semiconductor manufacturing as well, ranking just behind TSMC. Now, despite the rally, of course, it's had that phenomenal lift up in its shares. The ratings among analysts, they're pretty mixed. Some are saying it could be due for a pullback. You would expect that after its phenomenal run. But you might be expecting earnings upgrades to pick the stock up. That's something for you to consider. If we do see more earnings upgrades and this trend continues, it could be a shift for the stock, and the stock might be moved to a buy rating. Let's see if it can pack a punch and deliver. Let's change pace to an Aussie stock now, and that's Imdex. Their shares jumped almost 7% yesterday to record all-time highs. Why is that? Well, it's for a couple of reasons. We've been speaking a lot about commodities being on a red-hot tear this year and why you should be watching commodities, expecting higher levels. And this company, I guess you could say, is in the sweet spot. Now, Citi basically came out saying that this stock has got a solid near-term growth factor, and it should be on your radar. Most analysts actually rate Imdex as a buy, but their shares have already done really well this year. But the fact that it's got a buy rating reflects that you would be expecting, I guess, positivity in the stock across the year. So yeah, their shares are up 15% this year, and that is following last year's gain of 62%. So for those that don't know, Imdex actually is a global company. They basically serve the mining sector across different commodities, and they service the American and African regions. And they are definitely a stock that you should be watching. I wish I invested in this stock after interviewing the CEO a few years back. As always, plenty to watch and consider. Stay safe, happy trading.